Before we begin this podcast, we would like to remind listeners that NetWealth is licensed to provide general financial product advice only, and that this podcast isn't tailored to any particular person's objectives, financial situation, or needs. Before a listener acts on any advice in this podcast, they need to think about whether it's appropriate for their circumstances or their clients, and consider the product disclosure statement for any proposed investment, and also seek any professional advice they need. NetWealth Investments Limited is the issuer of NetWealth financial products. For NetWealth Financial Services Guide, contact details, and other information about our products and services, you can visit our website at netwealth.com.au. Today's guest is a financial product issuer. NetWealth and the guest have a commercial arrangement that enables investment in products managed by the guest through NetWealth's platform. Under that arrangement, NetWealth may receive fees from the guest. More information about the fees NetWealth receives is provided in our financial services guide.
Welcome to the NetWealth Portfolio Construction Podcast, brought to you by the NetWealth Investment Research Team. In this podcast series, we pick the brains of key wealth management professionals to uncover opportunities and challenges for investors on a diverse range of topics. We hope you enjoy their unique perspectives. This podcast series is an initiative of NetWealth. See wealth differently with a wide range of investment and superannuation options available on our online platform. In this episode, enjoy our deep dive on infrastructure investing with Ofer Karliner from Magellan Asset Management. In this chat, we discuss what infrastructure investing is, its benefits for a portfolio, and when we should expect driverless cars on our roads.
We have the pleasure today to introduce Ofer Karliner from Magellan Asset Management. Ofer is the portfolio manager of the Magellan Infrastructure Fund and now manages over $7 billion in listed infrastructure securities. Magellan is a Sydney-based investment manager who specialises in global investing, mostly through global equities and global listed infrastructure. They employ 28 investment professionals and manage more than $65 billion. Welcome, Ofer.
Thank you.
So, talking about infrastructure, would you like to give the listeners an overview of what infrastructure investing is and how do you define infrastructure investments for the purposes of your portfolios?
Sure. I think when you consider what infrastructure actually is, most people would agree it's something that's essential for the functioning of a community. So you want to flick the light switch and have the power come on, turn the taps, have the water run, get in your car and actually have the ability to drive somewhere because the roads are functional. For us at Magellan, we actually go a step further. We're actually a bit more conservative. What we want to achieve is very stable returns through time. That means stable cash flows through time. So we want to actually make sure that the assets that we invest in have those stable cash flows. So we strip out stocks that are exposed materially to sovereign risk, to commodity price risk, or to competition. And you think about what that means. For example, in the power space, utility space, electricity generation is highly competitive. So the power price fluctuates greatly from day to day, from hour to hour, from minute to minute in some cases. As a consequence, the cash flows you receive aren't certain. The regulated part in the middle, the transmission and distribution, is 100% regulated. We like those assets. We have great transparency as to the cash flows that will generate. Likewise, for things like toll roads and airports, they're regulated at price, so the price can escalate at a certain level. You take patronage risk, or we're comfortable, or we can understand the patronage risk that gets generated, and therefore we have good visibility as to the cash flows that those businesses generate. And that's what we're trying to achieve, is long-term defensive earnings growth with great downside protection and great inflation protection as well. It's not get rich quick, but it is to generate good returns for the long term with a great degree of certainty.
Okay. So you mentioned toll roads. It's an interesting area, and toll roads is an area looking at your biography as well. You had real specialisation and experience in. Talking about the emergence of driverless cars, what kind of impact could that have on toll road operators such as Transurban and Macquarie Atlas Roads?
Sure. Driverless cars are coming. They're sort of, there already is sort of level 3 cars, what's called level 3 cars at the moment, where you can go out and buy. Audi has a model where you can sit in the driver's seat and effectively the car will keep to its lane and avoid the cars in front of it. Same with Tesla's Autopilot is the other more famous one. Level 4 is the next level. It's out there. It's being tested at the moment by guys like Google and in fact by Uber, where effectively there's no driver. The driver can sit in the back, has an emergency stop button, but the car drives itself. These things are coming. I think that the speed at which they actually get deployed will be slower than what people think. It's not just the technological issues that are involved. It's also about the legislative issues, the ethical issues. So would you hop into a car that could kill you is the question. I say that, it sounds a bit trite, but effectively your car has to make an ethical decision. If a child runs into a road, does the car swerve off the road and kill the passenger, or does it kill the child? Now you make that decision now because you're at the wheel. And would it make a difference if there's an old lady or there's 3 people in the car instead of 1? They're not simple issues that need to be dealt with, but ultimately, safety should improve. I think the uptake will probably be a bit slower than people think because the turnover of cars is very slow. I've seen estimates by 2025 that most cars will be driverless. I think that's nonsense. Average turnover of car fleets around 5%. In Australia, it's about 4%. So it's quite. It'll take quite a lot of time for that to actually predominate across global markets. And talking to the head of one of the former senior people at Waymo, he said actually you have to learn city by city. The cars have to learn city by city. So it's actually quite a long rollout process as well. The benefits, though, are quite significant for toll roads. All highway grade roads will see close to a doubling of capacity, so the cars will be able to travel faster and closer together, which means you can fit more cars through the same bit of tarmac. The research suggests that arterial roads and signalised urban roads will achieve a sort of 5 to 15% increase in capacity. So you have to be more aware of people around you, more aware of dogs and children running to streets, has to look out the street signs, etc. So the benefits aren't as great. So what that means is cars are going to be drawn to the highway network rather than rat runs, etc. That's clearly a positive for toll roads. Moreover, as people start to the cost of being in your car decreases. So right now you get into a car, you put your hands on the steering wheel, look out the window, you can listen to the radio and maybe talk on the phone. All of a sudden, you don't have to do that. You can go to sleep in your car if you want to. You can work in your car, you can watch TV. The cost of being in your car comes down, the travel time decreases, it actually widens the city, pushes people out of the centre of the city, getting people being more reliant on highways. So we expect actually that, or research suggests that the number of trips will actually increase. Vehicle kilometres will increase to 3 to 10%. Plus, you have all this ability of, first of all, there's empty car trips. People who can't drive now can suddenly get into a car. So my daughter may never own a car, for example, never drive a car, I should say. Old people who can't, or are blind, or have difficulty seeing, or arthritis in their hands, all of a sudden they can hop in a car and get it to take them where they want to go. It's induced demand as well. So all these factors together mean that they'll actually see an increase in number of trips done and the kilometres travelled. Positive for toll roads.
That's really interesting. So you're talking about maybe that cities change in composition as well. And I mean, this is, I suppose, a side point as well, that there's different bits of infrastructure need to be built outside of the major urban areas. You see a bit of a change out of that?
The really dense urban hearts may actually benefit from transport as a service. So you push a button, a car turns up and you hop in the car and takes you where you want to go. So it'll probably see a decrease in car ownership in the dense urban centres, places like New York, for example. But people will still own cars, in my view. There's a huge... it's not economically rational for most people to own cars now. They tend to get driven sort of 4 to 5% of the time. You drive to work, you drive back from work, and it sits in a garage at either end. But people do it because it's convenient. You have your car set up the way you want it. It's personalised. You have a baby seat in the back or a roof rack on the top. But as people move further and further out, the infrastructure will need to support that. So whether it's improved road systems, better signalisation. As you come off those roads, you actually have to support the networks, have to be able to support that as well. Another possibility is you have infrastructure hubs where your car will drop you off at a train station just outside the city and the train takes you in the rest of the way, for example. But there are a number of solutions that could be ultimately seen to maximise the efficiency of the city design. I've heard some people talk about driverless cars replacing public transport. I think that's very difficult, particularly if you take, for example, the number of trains going to the CBD and then people getting on trains. If you replace each one of those, even with 5 people in a car, you're still getting sort of 60. In Sydney, I think it was 63,000 additional car trips in the CBD during peak hour. It's simply not going to be able to cope. So there will be solutions, but ultimately it comes down to individual cities and the way they can structure that usage best.
Well, okay. So we're talking about inflation protection as well before. You're talking about how you define about infrastructure assets, but just talking topically now about some concerns, especially emanating out of the US in particular, about rising inflation and therefore rising interest rates. How do you think that the infrastructure stocks are going to perform in this kind of environment?
So, first of all, we expect volatility to increase. So I think the marginal buyer and seller of these stocks tends to treat them as bond proxies. I think a specialist can look through that and actually understand the underlying cash flows. So I think we break it down into 2 parts, the impact on valuation of interest rates and the impact on the business itself. So in terms of the business itself, if you're a utility, you're allowed a guaranteed return on equity. If your costs go up, you can pass that through to customers. And there may be a lag, but ultimately you can pass it through. Therefore, you're insulated from that. To the extent you have infrastructure assets, generally regulated at the point of price, and by and large they have CPI-linked toll increases or price increases. To the extent interest rates increase due to inflation, you're passing that through anyway. And in fact, it could be a benefit to some degree because you're passing it through more quickly and the cost of debt rises. To the extent real rates start to increase, that's where we start to have an issue. For us, we're already quite conservative in the way we think about it. Central banks around the world are manipulating the risk-free rates, and as a consequence, they're materially lower than what they should be in a natural environment. As a consequence, we've gone back and used long-term historic rates as a proxy. So, for example, we use 4% nominal, 2% real in the US. To the extent the real rates move above that, then we start to have a direct valuation impact, but we're already factoring a move to sort of 4% nominal, 2% real in our valuations. We've accounted for that already.
Yeah. And talking about, I suppose, regulatory conditions, because a lot of these concessions are really granted by government. And so that political risk about the rules changing is such an important part in infrastructure. So how do you keep on top of regulatory change, government policy, and changes to that environment that could really hugely affect many of the assets that you may own?
Well, we spend a lot of time looking at the regulators, talking to the regulators, and trying to understand what's driving their policy making, but also looking more broadly at the political picture. So we recently did an analysis of all 50 US states, looking at, for example, whether the regulator was appointed or elected, is it Democratic or Republican state, and the outcomes that generates for ultimately the return to investors, or allowed return to investors. Equally in the UK right now, the politics is overriding the fundamentals. So Jeremy Corbyn, the leader of the opposition, is talking about renationalising the water utilities and the power utilities in the UK. Clearly that's a big negative. He's actually gone out and said we don't have to pay fair market value for them as well. Personally, I think that's hugely detrimental if they did do that to the UK economy, because you sap confidence out the government is not going to steal your assets effectively. But certainly that's something we're very concerned about. I think there's a lot of value in a normalised environment in the UK, but we've spent a lot of time trying to understand the legal implications of what could happen if they did try to nationalise those assets. So we spent a lot of time focused on that.
Very interesting out of the UK, obviously with Magna Carta and protection of property rights, that they would do such a thing. But you touched on America and the political system, and it's been an interesting thing that's been talked about in infrastructure circles for many years about the old infrastructure that is around in the United States and how roads and bridges and so forth really need to be replaced, and about an infrastructure boom that would occur in the States. We haven't seen it.
No, I've been surprised by that. I think I wrote a report more than 10 years ago talking about the impending boom in US infrastructure, and we just simply haven't seen it. The politics is such that it has to be approved at multiple levels of government, and all sorts of interveners get in the way of that approval process. And so the political will simply hasn't been there to actually get this done. And so the Avenue 2 line in New York is a great example, first proposed in 1917, 1919, and got completed last year. So it stopped and started. The politics and the approval process took a very long time. So there's a whole lot of issues there. And no matter what you think of Trump, his attempt to try and clean up some of that process is actually going to be beneficial for the sector as a whole. It is a strange accident of history that if you think about US being one of the champions of the free market, that privatised infrastructure really doesn't exist outside utilities. I mean, you have rail as well and towers, but roads, airports, for example, there are very, very few privatised toll roads and airports in the US. There are a few, but not many. Where you look at places like France, which is a socialist or quasi-socialist country, their interstate highway networks all privatised.
And how much would it cost you in tolls to cross France?
I couldn't tell you the actual number, but
it's hefty. It's hefty.
It's material. Yeah. But people, it's a user-pay system, and people tend to understand that. Where in the US and to some degree in other countries, people think I've paid my gas taxes or my petrol taxes why should I pay again for the road? But ultimately means the tax burden is shared by everyone, not just users of the road. So no matter what you think about toll roads, generally, if you think people who use the assets should be paying for them, then there should be a shift to that view. But politically, it becomes difficult.
Yeah.
Because if you're one who has to pay for it, then all of a sudden you may vote against the person putting it in place.
Mm. And then you didn't touch on Australia in terms of, that's probably another country that has a lot of privatised infrastructure assets. But further to that, I think it's a really interesting, fact about how dominant and how many specialist infrastructure managers that we really have here in Australia, both in the listed and unlisted space. So just from your perspective, working within the infrastructure industry here in Australia, what's made Australia so good at infrastructure investing that the rest of the world really sees a real specialisation here?
I think part of it was the fact that we were one of the first people really to focus it as a sector. We had a lot of privatisations in sort of the 90s and that helped drive that understanding and appreciation of infrastructure as a sector. And we also had a view that looking at across the world, these asset classes this asset class is a very attractive one to invest in for the very long term. With that view, we built a level of expertise within the country that started looking first of all in Australia and then more broadly across the world. We started exporting that capability across the world as well. And so Australia has grown up to be one of the dominant players in infrastructure globally. Both on as you said, on the unlisted and listed side. I think half the global listed infrastructure managers are based in Sydney.
Yeah.
It says a lot for the capabilities that have been developed in this market.
Mm-hmm. No, it's really quite amazing. And just heading towards the end, so just talking about yourself, do you have any particular investing rules that you adopt both personally and professionally? Sure. Any adages that you live by?
I'm a bit of a contrarian investor. I think you need to be able to look through the noise in the market. So when the old Rothschild is buy when there's blood on the street, you want to be able to look through the noise. Don't get caught up in the hype. I think is most important. Do your own research and really read and understand the underlying business that's driving those cash flows. And when you can do that, you can get confidence to invest when other people are fearful. Yeah. And that's one of the ways you protect capital and also you generate wealth.
Yeah. And on a contrarian sense, is there any kind of sectors in particular that look out of favour that...
Yeah, so for example, in our portfolio at the moment, we've been for quite a while now, particularly underweight utilities. Naturally, we'd probably be about half utilities infrastructure. At the moment, they're about 27% of the portfolio, 28% of the portfolio. We think in particular in the US, they've run up enormously, had run up enormously up to the end of last year. People would simply buying them on yield. And we just couldn't get their own valuation. And we weren't going to hold assets we didn't believe in. Again, we're an absolute return manager. We want to be confident we can generate returns through the cycle and actually protect capital as well. So we're particularly underweight US utilities at the moment.
And even going back, I do recall, say, during the European debt crisis where there's a lot of really good quality European assets there, but there was so much a negative sentiment towards Europe. Yeah. And but a lot of Aussie managers, I think, really saw through that. And it's probably, again, on the contrarian side.
So I think particularly in Europe, there were some amazing opportunities to buy really good assets at really cheap valuations. People were extraordinarily fearful. But again, if you can look through that noise and understand the cash flows of those businesses, we're never going to be the marginal pricer of those securities. We're simply not big enough. The marginal pricer will be the domestic equity investor. They sell Italy, for example, as a trade, or they get pull money out of the market. They don't necessarily look at in the same level of depth as we do as a specialist would, and that gives us opportunities to make material returns in those asset classes by simply doing the work and doing your homework and understanding what the risks are and the returns that you could get from these assets were.
Yeah, excellent. It's a real fascinating topic, and I just want to thank you, Ofer, for joining us here in our office. And thank you, listeners, for joining us on the Investment Series podcast. I hope you gained some valuable insights into the infrastructure sector, and signing off.
Thanks for listening to this episode of the Net Wealth Portfolio Construction podcast series. For more episodes and to subscribe to our series, visit our website www.netwealth.com.au or visit the iTunes Store or Spotify. We hope you can tune into our next episode.